eventually you're just going to move to where the most capital efficient markets are. Unfortunately, with CeFi and CeFi lending, we confused leverage with capital efficiency. Now I think there's an element that's transparency in addition to capital efficiency, because you want to know that your counterparty is at least going to be around for the next week, month, quarter.
All right, everyone. Welcome to the very first episode of Bell Curve. We actually had episode 0 that went live before, but Jason, what's going on, man? Welcome to the show.
Welcome to the show. I'm excited about this.
Yeah, me too, man. All right, we're going to be giving you guys an intro. In case you guys, just a refresher for what Bell Curve the show is. Bell Curve is a 2-part show per week, and it's divided into different seasons. So in season 1, Jason and I are going to be going over a thesis, which we call the DeFi credit boom, which is we're going to be talking about the unlock that fixed income lending is going to have in crypto. We detailed the entire thing out in episode 0, so definitely go back and listen to that. It's only like 10 minutes. You only have to bear through so much of Jason. Haha. Sorry, buddy. But it's good. It
says Mike number 2, which you'll get it. We'll get into why Mike is Mike number 2. But yeah. Just be careful who you're roasting here.
I feel betrayed. But the TLDR of that basically is we've got a thesis. We're exploring it in 3 parts. Part 1 of the thesis, we're calling it the death of CeFi. That's what Michael and Vance are going to be talking about with us today. So that's all of the recent implosion in CeFi is going to push a bunch of activity out into DeFi. That marginal activity is going to cause a big boom and renewed interest in DeFi. One of the unlocks that we're going to get is the transformation from variable into fixed rate interest. The ability to borrow at a fixed rate is going to lead to a renaissance in DeFi credit markets. There are going to be a whole bunch of different structured products on top of that fixed rate ability. And then we're going to see that's going to be a big part of the next boom, the next bull cycle. So today we're going to be talking to Michael and Vance basically about part 1 of that thesis, which is what are the repercussions, the second order ramifications of the recent implosion in CeFi, and what type of activity is that going to push out into DeFi, and what their thesis is for DeFi in the next bull market.
Exactly. Let's get into the show.
Do it.
All right, everyone. We got episode number 1 of Bell Curve, joined by Mike 1 and Mike 2. It's still TBD on who is Mike 1 and who is Mike 2, and then we got the real alpha coming from Vance today. This is episode 1 of a 7-part series that we're doing, exploring what is going to kick off the next bull market, specifically around fixed rate lending. This entire episode is about kind of the death of CeFi and the kicking off of DeFi. So, Mike, you want to do the honors to kick the show off? You want the first question of the first episode of the first season of Bell Curve?
Yeah. All right. Michael, I'll pose this to you because you actually were the one who used this on a phone call with me. You talked about, everything that we just saw in CeFi is going to be basically CeFi is done. We're moving into a new era of DeFi. Can you just walk us through why you think that is? What's the thesis?
Yeah. So to be specific, I would say centralized finance as it relates to crypto finance is just really having a tough time right now. When everything was living in an opaque, unregulated, and when all dust is done with settling, we'll see how shady it potentially was, but in a potentially shady way as well. It's really hard to be able to put trust into those institutions anymore. And what I'm referring to is everything from the Celsius, Voyager bankruptcies, and everything else that has happened over basically the last 4 months. And it's really difficult to not see in the future those types of institutions will need to be regulated like financial institutions in the way that we would trust a bank or a traditional lender. And I think that potentially breaks their business model. They don't have the ability to get regulated right now. They don't have, the strength of the balance sheet to be able to go off and compete with traditional financial lenders. And so you're kind of stuck between a rock and a hard place. And what I think this does at the same time is it gives an opening for DeFi protocols who actually very well performed throughout all of this consternation and violent upheaval, liquidation, everything. DeFi performed pretty well throughout. There were liquidations, nothing really broke tangibly, and everything kept on humming along. I think that was probably more of a feature of the over collateralization and basically the lack of capital efficiency that you potentially had with centralized crypto finance lenders, but you don't have the rehypothecation or the off-sheet balance sheet or off-balance sheet transactions that you would have if it was centralized and not on-chain and transparent. So there's a lot going on, but ultimately, kind of the way that I put it when we talked, Mike, was CeFi lost and DeFi is kind of remaining to be the victor.
Yeah. I'd love to get a little bit concrete. I don't want to like rehash the whole 3 arrows, Celsius, Voyager stuff. That's been pretty done. I want to start talking about like second order effects, right? So let's say like one of the first order effects, right, is that CeFi is basically delevered, right? And like the stats that I've kind of got is like these CeFi lenders were kind of running at like 6 times leverage. They've taken that down to like 1 or 1.5. And basically they're just kind of in like a frozen wait and see type state. So I'd love to get like concrete thoughts from you guys about what were the services that like centralized lenders, exchanges, et cetera, that were providing to the market, who is no longer going to be able to be served by those? Like what type of activity is going to move off of those platforms and like find a new space in DeFi?
Yeah. So the way that we borrowed, just to break it down, when we do borrow, there's a few different kind of sources. One is just like on exchange leverage. So, you lever up an ETH position, you go like on the perp swap, 10 to 100x, whatever your flavor of leverage is, you can do that. For us as an institution, places like Genesis, places like Nexo, like that's kind of like another source. Like we kind of stuck to like the Genesis side of that market, but the other kind of side of the institutional lending desk is like the BlockFis, the Celsiuses, the Voyagers, and those are the ones that I think are probably not going to be around anymore. The ones that were like taking in retail customer deposits and lending them out. And, Genesis will serve kind of like most institutions that go up to them that have good creditworthiness, KYC, good balance sheet. I don't know what the process for Voyager or Celsius underwriting was. I mean, like ex post facto, it doesn't appear that it was very strong, but like those are the people who will no longer be in the market. And if you think that, Celsius was lending out, half of its book at the peak, maybe that's like 5 to 10 billion. Voyager is probably like another billion. Celsius, you could probably get towards like, okay, there was like 10 billion of like net leverage that was lent out by those people. And that's the stuff that frankly is gone. And I think, that is domino effect into places like Genesis tightening up their balance sheet as well. I think for us, the question is now like, okay, there's cheaper rates in DeFi than in CeFi. And so, why would we use, CeFi if we really, didn't have to? And I think the answer is basically like, you can get white glove service, you can get like, billing statements, you can get all that stuff. But like that's kind of trivial in the sense of like on-chain lending, like all of the information is on-chain. There's tax accounting packages that are built around it. So yeah, I mean, it's a really good question as to like, do places like Genesis really stick around either? Because that is the avenue that seems most vulnerable to being disrupted and put on chain. And so, yeah, I think this all happens in probably the next 6 months. Like Genesis is going to figure out pretty quickly that there isn't quite as much borrowing demand as there once was. And any borrowing demand that there is rapidly moving on chain. And they're moving on chain for a couple reasons. The rates are cheaper. And I think the underwriting is actually more advanced on chain at this point. Like if you look at things like Maple and the credit oracle that they use, they use an oracle which basically can tell them what our balance sheet is doing without exposing our positions to them. And that's like perfect. That's what Genesis and all of these big lenders should have been doing. And DeFi is just leading the way on innovation with underwriting and risk.
Vance, do you think that some of this lend and borrow, especially the retail lend and borrow in the next cycle, will it basically get consolidated under the exchanges? Like will Coinbase and Binance and FTX almost play the function of like Nexo, Celsius, and BlockFi in the next cycle? Or will it not even, or will the exchanges not even play in that market because of they learn their lesson, they see how it played out with some of these lend and borrow only platforms, and or will it all move to DeFi? What do you think there?
It's worth noting that the lending, I mean, like if you look at like the FTX margin lending book, or if you look at Coinbase's like nascent lending program, or you look at like Binance's lending program, like those are for the institutions. Retail can't get access to that. But like I generally see institutional borrowing moving away from like the Genesises of the world towards the exchanges, because it's like a more holistic package. They can cut your fees. They can reduce your lending rate. They can charge you on custody. They have like a larger business model around lending than just the lending desk themselves. And so I see like them eating that lunch specifically. But for consumers, like they still can't get any credit from these exchanges. And so like the highest and best use of their capital in terms of, getting leverage is on chain. And I think that's really kind of where the vortex in terms of like the black hole liquidity comes from, where places like Celsius and Voyager were kind of like servicing that retail demand before. But now that those places are going to be gone or regulated like banks, like the only place for that capital to go if it wants to get borrow lend is on chain. And so, for one reason or the other, it'll get there. And I think by the next bull cycle, I don't know if we're going to ever see another Celsius or Voyager again. I'm just not sure how that would play out.
So you think a lot of the institutional borrow lend stays potentially with these big exchanges, and then the retail borrow lend is what drives into DeFi?
Maybe to jump in there, I think it's a mismatch of product capabilities and needs right now, but that changes very rapidly over time. It's the ease of use. It's, as we were talking about, like the fact that our CFO can get a brokerage or a bank statement or some, printout statement every month from Genesis to say, hey, here's what your invoice is. That's just one product cycle away from being something that's built into a DeFi protocol as well. So I don't think that it's really going to stay. I think it's just right now there's a mismatch, but it's rapidly changing. And frankly, if you can start to get more capital efficiency on chain, you're going to have a much deeper desire to go on chain. Like eventually, you're just going to move to where the most capital efficient markets are. Unfortunately, with CeFi and CeFi lending, we confused leverage with capital efficiency. Now, I think there's an element that's transparency in addition to capital efficiency, because you want to know that your counterparty is at least going to be around for the next week, month, quarter. That's a tough position to be in from an institution.
The last part that I would say, like, that we think about when we borrow and like on DeFi, you have like the Oracle prints, like you can kind of update tenderly to notify you if your positions are getting close to, being in trouble. With CeFi, they'll just like give you 48 hours. And, it's like, that's nice. But I think overall, we prefer the transparency relative to counterparty risk for really large sums. And I think that is like the exact opposite of probably how we felt a year ago.
What made you, is the reason for that switch just like, is the ultimate thesis here really about opacity when it comes to, because I think this was like a lot, we're not just talking about like an insignificant, like, oh, there was like one bad actor in the centralized lending space. It was like arguably the majority, right? And if they weren't like outright bad actors, it was like at the very least, there's a lot of irresponsibility, I think, going on.
We fortunately never really ran into this issue, but imagine a situation where you call up a bank and you're like, hey, I need to get my capital back. I need to get my dollars back. I need to get my assets back. And they're like, sorry. That's a really tough position to be in, especially, when you're trying to manage multiple positions, manage multiple counterparties, manage, a wide array of active participation as we are. And this is all the Framework Labs kind of active side. The venture ecosystem for us, at least, is a lot more vanilla. But the active stuff, if you're an active participant, like you're spread pretty far. And if one counterparty gives you kind of like a block, it could have ripple effects throughout. And just hearing the anecdotes of what some of our peers have run through and, what it's like to have that response on the other end, it's never something that we wanted to be in a position to have.
Michael, really what you're talking about is just a bank run, right? So all these small lend and borrow platforms saw bank runs. Can you just explain why the idea of a bank run like doesn't exist as much in DeFi? Like why isn't that possible in DeFi?
So yeah, and this is something I think I wanted to dig in earlier, but good time to bring it up now. Really, what these centralized platforms were doing, they were taking in assets as collateral, and these assets could be in the form of anything from USDC, Bitcoin, Ethereum, Link, any of the assets that are kind of like commonly used as collateral assets. The problem, though, is that when you have liquid volatile assets as your collateral base, it's very easy, especially in downturns, to be able to get close to a margin threshold where you won't be able to maintain the amount of borrow that you have in a way that they will accept. And therefore, you'll probably get what's called a margin call, and then you'll have to either put up more collateral to pay back, have to put up more collateral to re-collateralize, or you'll have to pay back some of your loan. What's going on in the background, though, that I think is really important is it's not like Genesis is just sitting there and saying, okay, you have 100 BTC here and you've borrowed, $50,000, and then we're just managing this as a separate account. They've got hundreds of accounts. They've got thousands of accounts, and they're rehypothecating these borrow and lending scenarios where they're taking the Bitcoin that you have as collateral and they're lending it out to somebody else. And what happens in these types of situations is, imagine we're getting stuck just because we have 3 or 4 counterparties. Well, imagine you multiply that by 100, and you're talking about a centralized provider. And it could have been any of these, and just using Genesis as the example, but it could have been any of these that you go back to them and you say, hey, I want to get my Bitcoin back, and they say, sorry, can't do that right now, and you basically have to wait for them to either have the term loan end, or you have to pay back the collateral, or you just kind of have to hope that they don't end up margin calling you and selling your collateral to pay back your loan that you have with them. So these types of situations become pretty hairy pretty quickly. But when you don't have the ability to view through to where your collateral is, as you would in DeFi, that's where you really get into a potentially tricky situation. And once again, I think that's where we confuse leverage with capital efficiency.
So ultimately what we're talking about here is just 2 different models of providing financial services, right? And in this one model, you have kind of the legacy model, which is this opaque bank. And the risk there is you have no transparency into what's actually going on. But 2, your assets aren't actually yours, right? Now, the thesis is that a lot of people that were going to these basically shadow banks, right, for financial services, they're actually going to go to this other source for different types of products and services, which is DeFi in general. And I think there's probably what we've been largely talking about is the ability to speculate, so to take out leverage. But then also further off, there's actually legitimate products and services that like hedging, right? Your risk in a business, or doing longer term borrowing and lending, real economy type stuff. I think those things walk hand in hand because usually those services require a deep market of speculators. But let's actually just walk through one thing that I don't understand is, let's talk about the leverage side of things first. So right now, when you go to somewhere like Genesis, they're actually leveraging that flawed model of rehypothecation to provide you a loan, right? They're kind of underwriting you guys at Framework, and they're being like, all right, these guys have a pretty good track record. They've got some capital, in case things go sideways, and then they write you the loan. How does that work in DeFi? How does leverage creation happen in a DeFi type scenario?
Yeah, it's pretty simple. You send funds to a contract, and it's like a buy asset type of contract, and so you're sending it to an ETH pool on Aave, and then once you have that, you basically get what's called an LP token. So you get a ETH, and then once you have that, you can access their USDC liquidity, and you can borrow up to I think it's probably if the value of your collateral dips lower than 120% of your loan, that's when you get liquidated. So that's about the most you can borrow in terms of those dynamics. And usually when we borrow, we'll put up a lot of collateral, 2 or 3x the amount of loan that we have, and if it ever drops down, we'll retop it out. And that's kind of how it works for all of retail today. And the thing about, if you look at Aave, they have variable rates, but then they have kind of fixed rates, which get adjusted every probably month or 2 or quarter. They're not exactly fixed. And so you can kind of lock in your, cost of capital to some degree. And so that's kind of Aave. When you look at Maker, which is a different way that you can kind of, get leverage in DeFi, what they're doing is you're putting ETH in a contract and you're drawing DAI against it. And people aren't holding DAI and lending it to you. That protocol is literally creating that DAI out of thin air, backed by that collateral. And the benefits of that model relative to something like Aave are the loans or the rates are usually a little bit cheaper because you're borrowing DAI, not USDC. They don't have to have someone source and provide the USDC to Aave. They can just create it out of thin air like they do with Maker. And yeah, it's a little bit different of an approach, but that's generally how leverage works in DeFi.
That's the big difference there between how we talk about leverage in crypto, what you just described, and how leverage is typically referred to in TradFi is that's an over collateralized model, versus if you trade options or future or basically any type of derivatives in TradFi, it's under collateralized.
I was going to maybe double click into that perspective in particular, we're starting to see with things like GMX and some of the new decentralized trading protocols where options and decentralized perpetual futures, as they've been traded on centralized venues like BitMEX and Deribit, they're actually becoming viable in DeFi as well. And so with a pretty strong liquid market, you can get leverage from a perpetual future or an option, for instance, which isn't the exact same process as what Vance is talking about. It's a little bit different, but you can kind of get a more capital efficient model as you would have in centralized finance in DeFi now.
Can you explain how that works, actually? Because my understanding, like at a bank, right, they extend you like a line of credit. How does that work in a DeFi scenario?
It's very similar to the limitations and controls that you would have in the comparison of like an Aave or a Maker to a centralized lending platform. If you put money into BitMEX, BitMEX is a centralized provider. They will take your Bitcoin, they will use it as collateral, and then you'll be able to trade off of that collateral pool with some, leverage effect. And let's say you go up to 50x leveraged. Something like a 2% move down means that, or up, means that your entire collateral that you have to trade against is gone. And their liquidation engine manages all of that and liquidates the Bitcoin and sells it on market. And that's how it works. That's also generally the way that it works in DeFi, but you're putting up collateral that is then managed by a protocol as opposed to a centralized entity. The major difference here, once again, is it's probably not as fast because it's not centralized. And as blockchains get faster, it'll become more and more capital efficient in that respect, but it is much more transparent. You can see what all of your assets are in that wallet, all your positions are in that wallet. And you can trust that it's a unified Oracle model that's updating the liquidation engine and then processing everything on chain. And I know that historically centralized trading venues have had issues with people just kind of like randomly getting liquidated, even though they didn't expect to be. So I think it becomes more fair and transparent. But then that also provides the ability to have potentially cross margin where you can use some positions that are maybe in that protocol, in that platform that are a perpetual future or an option as an asset that you could then cross marginalize with something like, a loan or something that you would borrow against. So there are kind of advantages to having that transparent nature, which is maybe the next step above where we are right now. But that's, I think, directionally where things are going.
I feel like folks have been talking about DeFi options and DeFi derivatives for a while now. Why haven't they taken off yet?
I think a couple reasons. The first one is like blockchains just have not been fast or cheap enough for you to really run these like protocols which require you to update every 0.0005% price change, the Oracle and the actual system. So that's been one challenge. It's also been like historically very expensive for people to do it on ETH1. Like we've kind of only had really blockchains that are fast, cheap, and reliable enough for the past like 6 or 9 months for this to really happen at scale. And like DYDX is like an interesting example, but like they didn't write any of their own code on Starkware. That wasn't really something that like had a long-term future. And so I think a lot of people had trouble adopting that as a result and getting to that platform and, depositing it in something that frankly is more of like a centralized custodial model. Didn't also check all the boxes for us in terms of, why we would use DYDX versus something like a Binance. Longer term, I think, I believe that, like basically all retail will eventually converge on decentralized venues. It'll be faster, it'll be cheaper, it'll be more transparent. You'll have more visibility into how the insurance fund works when things, that are bad happen. You'll have more guarantees on the Ethereum side that the protocol will continue running in perpetuity versus things like BitMEX, which, have notably shut down in periods of high volatility and liquidated people. And generally, it's just like the most global platform for people to trade on. And there's many benefits of that. Also like you can get tokenized ownership of it. You can give that to your users. Like the same playbooks that we saw work in DeFi will work in DeFi derivatives. In my opinion, it's mostly just been a timing thing. And so, yeah, I mean, that is DeFi derivatives. I think that personally, like the people who crack that are going to be some of the largest protocols in crypto. Like if someone airdropped you into crypto and told you to point to where the profit centers were, it would be the perps and the options platforms. So on the perp side, I think that that's a product that's unique to crypto that doesn't really exist in TradFi. And so like Options are really big on Robinhood, obviously, but like people have never used perpetual swaps. Like that's like a really amazing product. And I think if that had been in TradFi, options would probably be less popular. I think we're seeing kind of the opposite play out here, where first we're going to see adoption of the perpetual swaps. And I think we're starting to see that with Synthetics and GMX and DYDX now. And I think, the ones that are fast follows behind that require leverage to do things like delta hedging are the options protocols. And people like Lyra, I mean, like we've backed probably 4 or 5 options protocols, and like, we've just been waiting for one of these to hit. Like Lyra seems like the first one that has like the right confluence of the right ecosystem, the right users, the right user experience. And yeah, we're hopeful. These things just take some time.
So, for folks who are listening who might not be aware, the option or the market for options, but definitely derivatives writ large, is like many orders of magnitude larger than it is for spot. And that's a relationship that already exists in crypto on centralized exchanges, right? The derivatives market, which is basically just futures for crypto on centralized exchanges, is already larger than the market for spot is. So I guess I'd be curious, like, do you guys see, what do you think is the catalyst? Are you guys just like, you mentioned you've taken a couple of different bets on the space so far. Is it just like there's not enough liquidity yet? There's not enough people who want to use decentralized options? Is there something that like gets us from point A to point B, or is it just like a matter of time?
I frankly think it's not really a silver bullet. I think it's a bunch of lead bullets over time. And we're slowly building out the infrastructure, the liquidity. Think back to 6 months ago. Basically, nothing was on layer 2 from an Ethereum perspective. You really didn't have any liquidity on any of them either. So people are just getting used to what it's like to bridge over and be comfortable with that in the first place. I don't know about you guys, but like I get nervous every single time I touch a bridge, even if it is from L1 to L2. And so like all of those things are just going to take muscle memory. And I think frankly, one of the things that I would love to see is a centralized bridge from L1 to L2. Maybe a Coinbase supported bridge, Optimism, Arbitrum, wherever. Just because you wouldn't have to use the decentralized version, and that would just become the trustworthy on-ramp. So those are some of the things that I think about mostly. I think also just given the backdrop of crypto macro and everything that's gone on over the last few months, like there's not really a desire to jump back into the leverage game anytime soon. And so it's kind of a confluence of a lot of things, but I'd probably say those are the 2 biggest things in my book.
Cool. And I think the reason that we're focusing a lot on just this particular part of it is like speculation has been such a big use case for crypto writ large. So in DeFi it would feel incomplete to not talk about it, but also, deep options markets, that's kind of like the clay that you can use to make other types of financial products, right? Like the theme of this season is transforming variable into fixed interest rates. And you can't do that if you don't have a deep and liquid market for options. I actually kind of want to transition to like that part of the discussion. Like, what are some of the different types of financial products that you guys are excited about in DeFi? Vance, I actually heard you describe this on an old episode of Bankless, where basically like one of the big innovations that DeFi has is if you wanted to create a financial product before, your path to doing that was like working at Goldman for like 20 years and then making some weird institutional product and like marketing it to this tiny group of people. Whereas now you can be like a 12-year-old in Indonesia and like write a contract and like millions or hundreds of millions of dollars are flowing into it. So like on the actual like services, like products that people are going to use in DeFi, like what is the overall advantage of a DeFi versus a CeFi system? And then what are some of the new products and services that you guys are either investing in and underwriting or that you see coming to market during this bear cycle?
DeFi relative to CeFi advantages, I would say there's probably 4. The first is just like global wallet distribution. So historically, like think about like all the Australians in DeFi, Kane and, the whole gang, the GMX guys, like all of these people. Like historically, Australians have been confined to Australia. Like they have not been able to ship global financial products to every country in the world. But now you have global wallet distribution. And so you write a contract, if you're a kid in Indonesia, if you're a kid in Australia, you can have people in China, the US, Western Europe, Eastern Europe use it. Like you get instant global distribution. That's just something that, there are no non-geo-gated app stores globally. Like if you want approval to launch in one market, it looks very different from another, especially in a category like financial services. So that's the first one. The second one is just like composability and just like the ease of development. It's a public blockchain. You can look at somebody's DAI stablecoin. You can put it into your contract. You don't have to go off and build that yourself. You can leverage and stand on the shoulders of everyone who's come before you from a development perspective. And that's what makes, creating an insurance company in 50 to 100 lines of code possible on a blockchain, where it's just not possible in a centralized institution. So that's the second one. The third one is just like tokens are very powerful. And that's not something that's endogenous to DeFi itself. It's endogenous to like just this new ownership and governance model that is in crypto. And so if you're building a centralized financial service in Goldman owns that. There's like, you're not bootstrapping an ecosystem around it. You're bootstrapping clients around it. But, that relationship is not as symbiotic as you have somebody who uses it. You give them ownership. You give them a reason to come back. You make it more sticky. You direct fees to the token. You can spin the flywheel. It's just this way to generate more reflexivity, more ownership, more loyalty. That doesn't exist in TradFi. And I think the fourth part of DeFi, which is, advantageous relative to competitors, is just like, this is where the fringe of internet culture is. And you're going to have different things develop on the margins than you will at the core of these, large centralized financial institutions. And so, somebody's building a inflation protected stablecoin. They built that in the last 6 months. That's crazy. And nobody really built that in centralized financial institutions. Sure, there's maybe products that service roughly the same area, but that's net new. People are tokenizing commodities and figuring out interesting ways to use those in financial protocols on chain. There's just this weird fringe, culture that's just pushing things forward at just a much faster pace. And so I think there's basically 4 benefits, and those are them.
No, I mean, that's kind of the breakdown that we have of just how we view this space writ large. And Vance kind of touched on this, but there's a lot of elements that aren't necessarily DeFi specific, but just endogenous to this industry overall. And I think that sort of the last point of the crypto native culture is really kind of the biggest component, because right now it's really interesting and it's cool to be working in Web3. And it's the one area of innovation in the tech industry that if you kind of take your scan around all the different subcategories, basically there's 2 places to be if you're interested in technology. There's zero knowledge proofs in Web3, or artificial intelligence and what's going on in AI. And frankly, the stuff that's going to happen in AI is going to happen at the biggest companies, because they have all the data and the trading models to be able to get there. And so if you want to push something new, if you want to push something that's creative, fundamentally creative, there's only really kind of one substrate to be dealing with right now, and that's Web3. So I definitely would double click on the internet native culture as being a huge component of this whole thing.
Let's say all this plays out. Let's say we do have this big DeFi credit boom. If you look at the last cycle, there were kind of I'd maybe say 3 buckets of borrowers. You had the retail borrowers, you had the funds that would borrow capital and deploy it because they thought they could earn more than the borrow rate. And then you had the Bitcoin miners ended up being a big group of borrowers. Who what is the group who leads who are the borrowers that fuel this next credit boom? Obviously, you probably have those 3, the funds, the retail folks, and the Bitcoin miners. But is there another group that hasn't participated that will now participate?
I actually think so, and that's Ethereum stakers or Ethereum staking pools. And the ability to put even dollars into a unified staking pool that people are willing to borrow to be able to go off and stake and earn that yield and hedge their price risk. I mean, this is what we're talking about when it comes to things like options or perps and the ability to build structured financial products. If you have the ability to hedge the price risk of ETH and earn the nominal real yield, sorry, not the nominal, the real yield of whatever percentage that is in ETH terms, that's a huge advantage product that just frankly isn't even possible in most crypto ecosystems right now, and definitely not at the scale that you would have with Ethereum. And so I think that's actually one of the most undervalued components, not only of just what DeFi can build, but also just what the merge means, because someone's going to pick up that flag and run with it. And it's probably going to be a large financial institution who structurally builds that product.
Yeah, I mean, I think the incentives for more borrowing are unique to staking over the next couple of years. And I say that because let's say that, you want to start a credit fund. And basically what a credit fund is you are taking on lower risk. You're not shooting for a double or a 3x or a 5x in the next year. You're shooting for a 10 or 20% return, and you want to do it relatively safely. And generally the types of strategies that these credit funds employ are like lending to other people, basis trading, so like doing cash and carry where you buy ETH and then you'll short the perp if it's in contango and you'll earn yield from that. And then I think like the third kind of arrow that's about to be put in that quiver is like the staking carry trade, where you borrow USD or you have USD, you buy ETH, you stake it. Like you're earning probably like at this point 5 or 6% yield. You'll borrow more USD against that. You'll buy ETH again. You'll stake that. And so you kind of doubled your position at that point, and maybe you're instead of like 5 to 6%, you're earning like 10%. But it's a relatively safe trade because like you're not just gonna get blown out unless the divergence between staked ETH and ETH really kind of becomes material, which over the next year should become less of a risk. But like all of the incentives are geared towards these types of trades being the new ones that are put on, and I think the ones that probably become less relevant in a scenario where ETH just is driving the market is like Bitcoin miner financing. And that's historically been like a very healthy area of the credit market because mining is super US dollar intensive in terms of like you have to buy machines, you have to pay people, you have to pay electricity costs. After all of the bad loans of this past cycle, that feels like an area where it's probably less of a like if you have 3 options in your credit fund manager, it's basis trading, it's lending to miners, and it's staking. Basis trading and staking feel like the relatively more attractive options and ones where you can actually lever them up and get larger returns.
I actually have a question for you guys about the way it was described to me about just variable yields in crypto. Like, where does that ultimately come from? I think you can trace a lot of that yield, like the ultimate source, the stake rate from major L1s, and like really like ETH. The ETH stake rate is like the variable yield. And in finance, you have this concept of the risk-free rate, right? You also have a perpetual source of yield in the form of the US government, right? Which is like constantly borrowing, right? And then the whole financial market kind of transformed that debt into various products. So do you guys view, in the same way that like Bitcoin borrowers, miners like a big form of borrow, do you eventually see kind of like a thriving market for the transformation of that variable stake rate for ETH into something that's fixed? So you get a bunch of like options type activity around that, and then you can build other structured financial products on top of that fixed rate.
Well, I think you just hit the nail on the head. It stems from the borrow rate, the real yield rate, which then could be leveraged into structured products based on tenor. Right. And what I mean by that is you'd basically be able to say, okay, the ETH real yield, let's say, is going to be somewhere around 5% in ETH terms. And then it's going to cost you some amount to be able to get basically the negative price impact of what that would be over a certain period of time, and you're going to have to pay for that duration. And so it's going to cost more and more the longer and longer you go out, which means that you're going to have to pay more for that hedge. But you could also, you could ladder it, you could do a bunch of different things. And over time, I think we're going to start to see basically a yield curve for what is the risk-free rate of crypto. And that risk-free rate of crypto, I think, is going to be denominated. Our bias is going to be that it's going to be denominated in some form of the Ethereum yield, the Ethereum real yield, because it's the most widely used and it's basically the most sustainable that you can assume. What's going to be really interesting, though, is activity and bull market, bear market cycles are going to have a real impact on what that risk-free rate is. And what we've seen, at least with Ethereum in particular, is that more ETH, not just in dollar terms, but in ETH terms, is consumed basically in the form of revenue for the Ethereum protocol as prices go up. And it has that effect over time. And so what you can kind of assume is that the risk-free rate will go up over time as markets go up, which may be kind of this auto hedging, auto rebalancing effect, where as markets get a little bit bullish or a little bit frothy potentially, you kind of have this balancing out where like, oh, well, I'm going to go sell some of my assets because it's just like safer for me to hold this like ETH structured product or this ETH risk-free rate kind of thing. And it'll be kind of like the shift from like historically you'd see like stocks to bonds, where it's like 60-40 and like, let's get a little frothy. Let's move more into bonds. I could see that being kind of the thought process that you have over time.
The irony of what you just described there is like we're talking about this on the day when Jerome Powell is, dividending his tea leaves, right? And basically what you're talking about is like a market-based pricing for interest rates, right? Where when things get really frothy, the cost of capital goes up. That should like turn things over. And then there's the same thing on the way down. The cost of capital, the real yield that you're getting gets cheaper. So it encourages people to borrow, right?
Well, yeah. Well, in particular, what I was saying is the risk-free rate, which would be probably a major variable into what you'd consider to be the cost of capital in other places. And if it's risk-free-ish, that would be kind of the way that you'd have to assume it.
TradFi, the risk-free rate is basically the 10-year, right? Whatever yield you're getting off the 10-year, which the Fed doesn't like directly control, but they control they control the shallow end of the curve. So let's talk about like Vance, you were starting to get into like some of the fringe experimentation that was going on in DeFi. Like, what are some of those things that you guys might be interested in? Because really, I think the future that all of us envision here is DeFi eventually becoming larger than not only the CeFi part of crypto, but even challenging, the size and scope of TradFi in general. And you need some financial products, right, that people want to use writ large and in mass to do that. So where do you guys see that innovation occurring today? I guess in DeFi, or like what would you be? What are some interesting areas that you guys might be looking at?
Yeah, so I think. Like talking about kind of the four different like superpowers of DeFi, which are like, global distribution wallets, composability, just the ease of building, tokens is a new form of just distribution, marketing, incentivization, and then internet culture. I would probably add a fifth, which would be you just have like this endogenous growth of, wealth within crypto. You have, 600,000 addresses that are active on a daily basis. They're super wealthy. That are willing to try new financial products. You have 100 billion or so of stablecoins on chain. You have 22 million ETH. I think that's, like almost $40 billion of ETH locked in DeFi. So like you kind of have all these interesting things happen, but at the same time in the background you have, and depending on if you're a bull or a bear cycle, but like over time, just like the amount of wealth on chain being created to use these products is increasing so much. And like if you were a traditional fintech, you would kill for these types of customers. These just like don't frankly exist in, traditional finance. Like this is like a crypto native thing. And like the crypto native customers are like some of the most valuable part of the flywheel and that keeps it spinning. And they're not just static. They're growing wealthier. They're trying more things. They're bootstrapping new asset classes every single time. And so I think the things that we look for are there's like obvious unchecked boxes. And so like, if you want to look at the categories, you have borrow lend, you have spot trading, you have derivatives, you have insurance, you have options, you have fixed rate lending. You have like things for like payment for order flow. You have things like staking, like, those are kind of like, I would say some of those categories have their winners already. Like we don't see many people funding new AMMs to compete against Uniswap. We don't see a whole lot of new borrow lend protocols being funded to compete against Compound or Aave. Like that is relatively settled. I think on the innovation side, I think, frankly, one of the most innovative and like new things that is especially a little bit new and old is Ethereum and like the birth of like real internet money. And like internet money is a meme, obviously, but like being able to create something that people identify as their base asset. Like I would probably say my base asset, same with Michael, is ETH. And it's just internet money that's not associated with a specific nation state that pays us a yield, and that we have a lot of confidence using as not only money, but also just like, our largest asset. And so I think that's like relatively new. And I'm getting off on a little bit of a tangent here, but people say that like, the risk-free rate of ETH is going to really hurt DeFi because like, what DeFi protocol will be able to compete with like 5% real yields. And I think that's like actually the totally wrong way to think about it, because when you have 5% real yields and people are staking ETH and they're putting it in DeFi, you're literally like supercharging DeFi with these yields and with this additional wealth creation that's happening on a more rapid basis now that it has yield. And so I think like the birth of that specific concept of internet money is like so innovative and it's going to power a lot of use cases that frankly like we can't even see right now. But yeah, I mean, on the innovation side, I think it's kind of this dimension of like, okay, what are the new financial products that we can build? What are the new financial products that we should build? Like can build, I would put like, the wrong intersection of that is like something like Squeeth, where it's like a really interesting financial product. Like it's really cool on paper, but like nobody actually really wants to trade that because it's like so complicated. And like, sure, we can build it, but like, should we build it? Like probably we should focus on things that are a little bit, closer to home in terms of, things that people understand and know. But Yeah, I'm trying to think of like the really new innovative stuff in DeFi that we've seen as of late. Let me give you a couple examples. So like one is like payment for order flow and like the whole wallet dichotomy. So like if you're Phantom, if you're Zapper, if you're Rainbow, if you're any of these wallets, like a lot of these wallets just like frankly have like a monetization problem. And traditionally how the monetization problem is solved in regular finance is you basically sell your order flow. And this is actually like a really interesting monetization model. The only problem with it in traditional finance is that Citadel is the only person who is basically allowed/able to bid on any of this order flow. And we've backed a protocol. It's called DFlow. It's basically like the first on-chain payment for order flow protocol where if you're a wallet, you can just plug in DFlow and you have market makers, you have DAOs, you have individuals, you have anybody who can run this software who's able to bid on your order flow ahead of time. So it like decentralizes the process. It opens it up to people just beyond Citadel, and it gives wallets like monetization in a box. And like that is like a new trend where, surprise, surprise, the person who started this protocol was an ex HFT trader at one of the largest HFT shops in the world. Like this new wave of people coming from Citadel, from Jump, from, HRW, from DRW, like these are the new people who are going to kind of define the DeFi of the next like 2 or 3 years. And they're going to bring a lot of the tools and tricks that they learn in these places with them. And so I think like broadly, it's hard to point to like a ton of like, okay, like there's 50 new innovative trends. Here they are. But like payment for order flow is one, MEV is like another. But all of these things are coming from the people who, once kind of ruled the roost in TradFi, which is exciting.
Only thing I'd add just to that real fast is I kind of think of it as like, and historically, I can't remember who originated this concept. Maybe it was Fred Wilson at USV, but like you have basically an infrastructure build out and then an application that's enabled by that. I think we're fundamentally in an infrastructure build out phase for the next generation. And a lot of the applications that are working now are the ones that were built based off of the last generation of infrastructure. And basically that's layer twos, that's oracles that work, that's wallet solutions that are usable. But right now, like we frankly are waiting to see what this next generation is going to be based on what the infra is doing right now.
I've got a question actually, and just a comment, Vance, on that idea that a 5% real yield is really going to hurt innovation. That actually might be more a reflection of the times where basically everyone thinks you need 0% interest rates to fund anything or produce any sort of innovation. Because like historically, I think that's actually pretty in line with what yields have been. But I guess one thing that I think the subject of this like interview series is like just debt products in crypto in general, which we haven't really seen, like DeFi native debt products. The TradFi equivalent, right, is like when even they're signaling about the drop of interest rates, that leads to this huge boom across everything, right? So I'd be curious, like, do you ever see a world where, we're talking about real yields based on the ETH stake rate that kind of moderate based on form these very natural kind of boom and bust cycles? Do you ever see when there's like basically a lowering of the real yield and therefore a corresponding drop in the cost of capital? Do you ever see that causing a boom? Because right now, like most of the boom cycles in crypto are based on like new token distribution mechanisms, right? Be it like, ICOs or yield farming or NFTs or whatever it is. But theoretically, like a lowering of the cost of capital in crypto should lead to the funding of new projects on the margin and like the way that it does in a TradFi type system. So do you guys ever see a world in which we have this like rich ecosystem of DeFi native debt products, and like that is actually what sparks the boom or like what kicks the cycle off, as opposed to more of like the token distribution side of things?
I think if you have like if the 10 years at like 3% right now, and the ETH stake rate is at like 6 or 7%, like your total cost of like if you're a rational person, if your cost to convert your USD into ETH, stake it, and then hedge out that risk is less than the actual yield that you'll get, like that should draw a lot of dollars into the system. And drawing more dollars into the system is fundamentally positive for crypto. More interest, more bullishness, more price action. That kickstarts part of the flywheel. On the other side, when you're just like, and that's like kind of like drawing in capital from TradFi to DeFi. And like, I think that's fundamentally positive. And so that could bootstrap part of the cycle. I think on the other side, it's like, if ETH is a 5% real yield, 6% real yield, whatever, and that's kind of just like the natural like bar for a lot of the investment that happens in the space. And I think that also kind of like skews people towards more risk-taking behavior, if that is going to be the natural kind of like barrier. And And so, more risk-taking behavior means more things that are innovative getting funding. It also probably means that, if you think about how the ETH yields work, basically ETH yields are, part inflation, but they're also just like revenue for the network. And revenue is calculated as the number of ETH spent per day times the price of that ETH. And for real yields to decrease, basically what you need is the following to happen. Price of ETH needs to go up enough where the quantity of ETH spent per day actually goes down. Because if you have picture ETH going up while fees rise on a quantity basis as well. So like back when ETH was 5K, 10 to 15K ETH per day was being spent. Really what you need is for the quantity to decrease as the price increases. And there's some barrier where that happens, but it just implies that things would need to get much higher in price for quantity to decrease before any of this re-rating actually happens. So I don't know. There's a lot of factors at play, but I could certainly see, and I certainly expect ETH, to draw a lot of attention, capital, and just innovation into the space overall.
Maybe one thing to touch on here, which actually I think just came out yesterday or the day before, is the example of what happens when you kind of move past token incentives into something that's real yield as well. Synthetics and we're an investor and have been for many years. They just came out with a proposal to stop inflationary rewards going to the stakers. And this would be basically a turning off of a massive amount of inflationary yield every single week to synthetic stakers in lieu of just having SUSD, which you could kind of consider basically to be the real yield of the protocol, going to the synthetic stakers only. And so I think there is an element of 5%, that's a really tough bar to hit. You don't have to hit that right out of the get-go. You can have inflationary rewards be something that subsidizes growth and engagement and frankly distributes ownership to the point where you get to that success benchmark of saying, okay, now we can turn off the inflationary rewards. Hey, we're ready to turn on just the real yield. And you could maybe say that that's what Ethereum's doing. I don't think that it's really been planned to that effect, but it is kind of a similar one with, getting rid of a bulk of the inflationary rewards in the form of EIP 1559, where you burn the transaction fees and post-merge, you're going to have lower inflationary rewards in the first place. So there are some elements of how you would do this, how you'd subsidize it, which I think are definitely success points.
Guys, if all this plays out and the debt markets really do get built, and Vance, all those products that you're talking about do actually get built, right now, the only real way that folks raise capital today is with just equity issuances, right? You issue tokens and you get capital and you use that capital to grow the project. In traditional capital markets, debt is much bigger than equity, right? And so I'm curious if you guys how you see the debt markets playing out specifically for DAOs, right? Do DAOs go out and instead of issuing a bunch of tokens, do they go raise debt? Do they raise debt on an recurring basis based on the revenue that the protocol's spitting off? Is it a one-time raise? Does it look kind of like what Pipe has done for SaaS revenue? How do you guys see this world playing out? Maybe Michael, I'd throw it to you.
Yeah, I was going to say Pipe as a potential model here. If you have sustainable real yield in a dollar denominated, core revenue producing function, there are a ton of new financing mechanisms that don't necessarily cost as much as early stage equity might, and frankly aren't as potentially burdensome or disastrous in the form of a full on debt offering, as you would see in sort of the two models that exist in corporate. In the corporate world. How this relates to DAOs, I could see there being some flavor of somewhere in between. Having something where you have a debt-like financing where there's some nominal yield associated with it and maybe a convertible element at a certain point, based on some success criteria. I personally haven't seen anything like that, but as we get to a point where you have, real yields becoming the norm, having these protocols be fee generative, such that they can sustain themselves, and you need to pull forward some of that revenue to be able to subsidize cost or grow headcount or do something new. I'm sure that there would be options for that, but to go back to kind of the original point, that's a perfect place where structured products become a real viable option here. So that could be, I think, a point of innovation just in terms of the product categories. Going back to what Vance was saying, building something that we can versus building something that we really need. This feels like, if there is a demand for it, it feels like something that we both can and potentially need to build.
I think maybe we can start to wind down here, and just rewinding to what we kind of talked about at the beginning of the show, right? Death of CeFi, this new era of increased growth, let's say in DeFi. If you look at exchange volumes versus maybe let's use the volumes that centralized exchanges do versus decentralized exchanges. Still, the majority of the volume is in centralized exchanges, even though you're starting to see there were days where Uniswap flipped Coinbase based in volume and stuff like that. I'd be curious to see just how you guys see, and let's say the next bull cycle, whenever that ends up coming, how large do you see DeFi being in terms of the balance between CeFi and DeFi activity? And if you're looking at it basically in terms of exchange volumes, or if there's a better metric that you're paying attention to.
I think next cycle, at least kind of how I expect it to play out, I think we'll have probably $1 trillion in TVL locked in DeFi. That would be kind of the next high water mark. We got to 130, 140 billion, actually probably more than that. I think it was 150 or 160 last cycle. And that was across all of the chains. I think Uniswap is probably, flipping Coinbase on a more consistent basis, or Coinbase kind of gets out of the exchange business writ large. Michael and I were talking about this last night. It seems like the future of Coinbase is really, two or three things. One is Coinbase Wallet. 2 is Coinbase staking. And then 3 is kind of the exchange business that they have today. And I think Coinbase Wallet eventually eats their exchange business, where when you open your Coinbase app in the future, it's just your wallet, and you're, trading through open source liquidity pools on chain versus what Coinbase has on their back end. And then staking is it generated $170 million of the last quarter profit. That feels like a business that, if it grows in order of magnitude, is generating, as much or more business than their exchange today. And so I think DeFi will not only, continue to grow and grow by, an order of magnitude or two, but it'll kind of fundamentally redesign a lot of the exchanges that are already in the space on the centralized side. And so I think that the products that stay really close to the chest in centralized finance are probably the derivatives platforms. Those are the most profitable. They're also the most regulated. But there's going to be an emergence of the decentralized options for people that, want to use DeFi for, the 4 or 5 major reasons that I kind of outlined before. But I think the other thing that we've noticed over the past, year or so is that, we launched 1,000 DeFi protocols collectively as an industry, maybe more. And I think people are really mad that not all 1,000 worked, and not all 1,000 have significant market share. But it was just never going to break down that way, frankly. And the fact that we have 20 winners is phenomenal. And we created those in the past 2 or 3 years. And we're lucky to have probably 5 or 6 of those in our portfolio. We call that a dub, and we absolutely love that. And how many more DeFi protocols will there be? Will there be 20 more? Will there be 30, 40? Will there be 100 more? I would say probably there's going to be another 20 winners when all is said and done. Maybe they're more regional, maybe they're more regulated, maybe they're more, they just have a different angle on customer acquisition. But I think, that's kind of my perspective. I think a lot of the winners keep on winning. I think the people who are still building and still innovating in the bear market are going to grow their market share. Just like Uniswap has 80 or 90% of spot AMM volume right now. When the bull run picks back up, a lot of their competitors are going to be, basically out of business, and they're just going to eat all of that upside as the bull run happens. So that's my perspective, at least. The other one I would say that we haven't talked about today is Maple.
Yeah.
And Maple is just probably the best positioned new credit creation venue in all of crypto. They're doing $1 billion, $1.5 billion in loan originations every quarter. They're growing like crazy. Their underwriting standards and innovation on that side is just way further ahead than CeFi. And they're also an interesting venue to get exposure to staking, where they have purpose-built staking pools that go off and kind of facilitate the credit trades and carry trades that we were talking about. They're definitely one that we heavily watch for. And full disclosure, we own a lot of Maple, but yeah, they're good people. They're Australians. We love them.
They're great.
Vance, do you think in CeFi, You saw basically like some of the winners, like the Coinbases and FTXs and Binances of the world, basically just try to eat market share across the board. So like an exchange would go into, they might launch a custody product or acquire a custody product, then they would acquire like a lend and borrow product, and then they would acquire like a prime brokerage type software platform, like Coinbase acquiring Tagomi. Is this going to happen in DeFi? Like, will the Aves and the blue chips of the world eat market share from other folks, or will just, you think new smaller companies like startups will win? Like, will Uniswap and Aave and Compound expand out, or what does that look like?
I mean, there's kind of like two schools of thought here. One is like the Aave, and like they're launching a stable coin called Go, GHO. And if you look at the rates between Aave and MakerDAO, the rates on Aave are usually a little bit higher, just because like they're not able to just like hypothecate the stablecoin out of thin air relative to Maker. And them creating their own stablecoin is just like a direct shot at Maker. They're trying to basically vertically integrate, lower their cost of capital, get more market share. And so I think like, there will be some people who choose to do that. Frankly, like that's more of an opportunity that's available to international teams that are outside of the US. Like I remember when Compound was going to have their own chain, was going to have their own stablecoin, like none of those plans came to fruition, I think for a number of different reasons, but one of them was probably regulatory. And so like, it kind of really matters, like, where you're domiciled. You have a lot more degrees of freedom if you're international. And yeah, I mean, look at what Synthetics is doing versus what DYDX is doing. It's like a very night and day comparison in terms of, like how aggressive they're being on the ecosystem side, on the incentivization side, on the vertical integration side. And so, yeah, we're going to see both approaches. But some people are going to be able to do it and others just won't.
Yeah. All right, guys. Really appreciate your time. This has been a fascinating conversation. We will see you next week for the roundup. Cheers, guys.
Looking forward. Thank you, guys.
All right, man. Michael and Vance, wealth of knowledge there. What do you think of the episode?
Really good episode. Really good first episode. Just kind of setting everything up and framing the conversation for the entire season. Yeah, I'm always impressed talking to those guys. Just they have a wealth of knowledge of not just what has happened, but I will say like what is coming down the pike.
Yeah, I would say that too. To just walk through everything, again, to reiterate, the reason that we wanted to talk to these guys is I think they were the ones who really planted this idea in our heads of the death of CeFi and like a new reinvigorated growth in DeFi, let's say. I thought they did a really good job of just recapping what the advantages were of DeFi over CeFi, right? So with CeFi, you've got the opacity, right? You have no visibility. But then there's also that persistent risk of rehypothecation that you have in CeFi. And there's even if you do everything right, even if you manage your own risk appropriately, your lender, the person who's lending you or the person that you're depositing your assets with on the CeFi side of things cannot be good. And then you just basically have no recourse. And they're more powerful. And there are constant stories about this. Like Marco Hodes has if you want like a TradFi analog, go see what happened with Marco Hodes and Goldman Sachs, right? Really, really, not great stuff. And you have very little ability to recourse.
Wait, what happened with Marco Hodes? I don't know that story.
Marco Hodes is a very famous short seller. I forget which position this was of his at the time, but basically he was completely in the right and he managed his margin requirements right and everything. His side of the story, but it's been corroborated pretty widely. And Goldman just seized his collateral. Anyway, stopped his trade out at a big loss. And he eventually ended up being right on the trade. Anyway, you can hear him talk about it on some episodes of Grant Williams, but like this is, I've heard the constant, this happens to short sellers in particular. It's a big challenge. So just understanding who your counterparty is, there's only so much that you can do and only so much recourse you can have in a CeFi type system. Yeah.
What do you think about Vance's idea that retail would actually be the first to flow into DeFi?
I completely agree with that.
Yeah.
I think the obstacles to institutional DeFi is still there. And ultimately, at the end of the day, I think that's the big...
The obstacle being what? Like the KYC, AML? They don't trust
the KYC, AML, and then also just the mental... Like even just listening to Michael, right? Like Michael and Vance are some of the most DeFi natives that you'll ever find. And even they still have like apprehensions about moving their assets on a bridge, right? And their layer of trust, like their real trust really doesn't extend that far out past Ethereum main chain. So there's just a lot, you gotta deal with like the mental barrier for like an older demographic in TradFi, but then you also have to deal with like, it's much more highly regulated and there's career risk that's associated for them that isn't necessarily the key. Like if Michael and Vance like lose some, I mean, it wouldn't be good for them either, but like it would be really unacceptable, right? If like a pension fund, loses money in crypto and then everyone's like, well, what did you think? It's a scam. So I think I totally agree that retail is going to be the first to move in a big way. But I do think for our thesis, right, to relate this back, the reason why we focused the two legs of the discussion on the market for options and derivatives and then the market for products is, again, there's an inherent link between deep markets, which are fueled by speculation, and those are traditionally derivatives markets. That's the clay that goes into building new financial products, right? Because the transformation that occurs from variable to fixed interest is basically you're basing it on a floating variable rate like LIBOR. You want to isolate a part of that, and the way that you do that is via an options market. So you need this deep speculative based market where there's a bunch of leverage. And that's an options market. And then you need that for there to be new financial product creation. And I think that's the biggest, we should really be diving into that for the rest of our thesis, because I think the biggest risk there is just time. And, we might be early on that part of that leg of the thesis, I think. But that's something that you and I should just be aware of and continue to ask guests moving forward in the future.
I think they made a good point too, that the introduction of perps into the crypto markets will probably slow down options.
I think it's, well, actually, I want to double check this, but I think Vance might have been slightly wrong. I actually think the perp contract actually does exist in TradFi. It had just never been widely popularized, actually.
I didn't know that. I didn't know that.
Yeah,
I didn't realize that.
Yeah, I'm pretty sure it has been. We'll double check that and put it in the show notes. But yeah, I'm pretty sure that the perp actually has existed. I'm actually not sure. Perps, the big advantage there, it concentrates liquidity, right? If you have options markets, then you have different expiries at different prices, and suddenly you could basically be trying to hedge the same thing, which is your exposure to Ethereum or something like that. But if you're doing it on a certain expiry, then suddenly you just fragment liquidity. So there's some definite disadvantages to perps as well, but I think that's the big one that perps has. But at the end of the day, I don't think it matters if it's perps or if it's options or whatever it is. Basically, you just need that ability to lock certain things in and hedge.
Yeah.
So
I love the conversation talking about the ability to create new products, right? If you are an innovator in finance and you want to innovate in finance, you have to go work at Goldman. You have to convince the risk team and the tech teams. And it takes years and years to go build a new product. But in DeFi, it takes sometimes weeks or months, right?
You know who transformed this view of the world for me is Matt Levine, when he talked about brokerages or banks are investment stores. And you or I have different needs, right? You and I have different needs, hey, you need a computer, you need a phone. That's very easy to understand. But we also have different financial needs, right? I need access to borrow so that I can afford to buy a house. I need access to borrow so that I can afford to buy a car. I need, I want to be able to I have this particular bet on how I think the future is going to unfold. I need you to create a product so that I can get exposure to my particular view. Banks, hedge funds, brokerages, they're creators and then distributors of different financial products. It's just the system that they have to manufacture those products and distribute them to the masses. It's a very legacy type system. I think the big advantage of DeFi is it just reduces the friction of product creation and distribution times X. I also think, for what it's worth, that's why people in TradFi get DeFi so much more intuitively and so much faster than they do Bitcoin. That's completely anecdotal, but I think because they understand what financial services are and how they get marketed and distributed much better than the average person, who, if you were to say that a brokerage is basically distribution, they'd be like, what? A brokerage is where I go to buy stocks. It just doesn't compute in the same way, I think, that it does for TradFi people.
Yeah. Clear something up for me. So Vance mentioned that a lot of people think that the 5% rate on staking is going to pull capital, is potentially net negative for DeFi. My understanding of why people think that is because it, if you can get 4% on a protocol, and in a pool or something, but you can get 5% just staking your ETH, then that's going to pull capital out of the pools. But it sounded like when you had a different interpretation. And so what, can you just tell me?
So yes to both. It all has to do with opportunity cost, right? So what would happen today if the Fed raised interest rates to 5%?
Yeah, capital gets pulled out of
stocks, right?
Right, exactly.
Capital gets pulled out. But the reason why, capital wouldn't get pulled out if the rate of return for stocks was 10%. The reason why interest rates are where they are is because markets collectively don't think you can earn higher than a certain percentage return on your other options, right? People are very concerned about that other rate of return. The reason why it might work with a higher percent, like a 5% real yield, right? Risk-free yield, real yield, that your 5% is your hurdle rate essentially for new types of investments, is crypto is growing like crazy, right? The growth isn't really the worry quite so much, I think, in this space as it is for TradFi. So that's like the distinction as well between where the Fed controls interest rates at the shallow end of the curve, which is where banks borrow, versus the long end of the curve, which is less determined by what central banks are doing and more determined by where people think growth is going. Does that make sense?
It does make sense. Yeah.
So the reason why the Fed is basically had to lower their interest rate is because their understanding of the economy is that it cannot bear a higher hurdle rate. Whereas in crypto, we actually do it is possible that you actually could bear that higher hurdle rate. And the reason why that's ultimately better is because if your hurdle rate for new investments is 5% as opposed to 1%, then all of the new investments that get funded will return at least 6%. Whereas all of the new investments that get funded in finance, in TradFi, in the economy today, won't return as much because the cost of capital is much lower. Does that make sense?
That makes sense. Yep.
That's why we have all these zombie companies.
Yeah.
Like that's why lowering interest rates to a certain point is actually counterproductive because it encourages malinvestment.
Yeah. What's coming next? This was a really good episode to kick off the season. What is the next episode? What are we talking about with Tushar?
So we're talking about two things with Tushar, right? So here's what we covered on this episode where it relates to the thesis. And I think we were largely validated, right? What I think we did cover in depth is that we see a much diminished presence of CeFi in this current cycle, but moving forward after that, it gets less and less and less and less. So almost like the new Bitcoin dominance, right? Which is just like, that's been a one-way track down essentially. And I think that's what CeFi is going to be relative to DeFi moving forward as well. So I came away from this conversation pretty confident that that's going to be the case. What we're going to be talking to Tushar about is two different things. One, we're going to be talking about interest rate swaps. So that's actually the market that performs that alchemy of transforming variable rate into fixed rates, right? So a swap is basically you're swapping future cash flows. So people use it to like hedge interest rates, but they also use it for options and things like that. So interest rate swap markets in crypto, DeFi native interest rate swaps. Tushar also was the one who gave us the idea of, okay, largely what token financing is that some form of equity financing. And that's what catalyzes booms in crypto. We want to get his opinion on whether or not we think debt financing, right? The creation of a new suite of credit products, whether that can kick off a bull wave in crypto in the same way that equity financing, token distribution innovation has in the past. That's what we're going to be talking to him about.
That episode drops next week. If you guys are excited about it, hit the subscribe button. Anything else, Mike? That's it. See you next week.
See you next week.